So you turn 62 years old and you're ready to retire, and someone comes up to you and tells you you need a HECM. Are they talking about some new medical procedure? Well, on Inside Secrets today, we're going to talk to an expert and we're going to help you understand if you really do need a HECM. And more importantly, what the heck is a HECM? Welcome, I'm Kenneth Manessi with KeyToVegasHome.com right here in Las Vegas, Nevada, powered by eXp Realty, and also the author of this second book, Inside Secrets 2, What I Wish My Agent Would Have Told Me About Reverse Mortgages at Retirement. Each week we have an expert guest, and this week we have a returning expert guest, Rick Rodriguez from Fairway Independent Mortgage. Rick, welcome back again to the show, Inside Secrets.
Ken, thanks so much for having me. I feel very honored to be a repeat guest on your show. Can't wait to get into some topics with you and pick up where we left off.
Yes, and one of the things that I wanted to talk about was something that I have been discussing with people, and more importantly, other people have been talking about, but what the heck is this HECM and why are we talking about it? More importantly, can you unpack what a HECM is? Obviously, it's an acronym for something, but why is it important for those at 62 to consider it? First of all, let's just agree it's not a medical procedure. So what is, Rick, a HECM?
Yeah, definitely not a medical procedure. And it is an acronym, as we love acronyms in this day and age, right? So we got to have our acronyms out there. The HECM stands for the Home Equity Conversion Mortgage. Home Equity Conversion Mortgage, and most commonly referred to as a reverse mortgage.
There you go.
What most people know or have heard about the product, they've heard in the light of its most common name, reverse mortgage. But if you look at the technical name of the product back in the HUD handbook, another acronym, the Housing Urban and Development Agency,
Yes.
Government agency who monitors, insures different programs. They're the ones who insure the HECM, and it's an FHA product. So FHA is the division, another acronym, right? We got to be careful. Federal Housing Administration, government agency who oversees mortgage lending products. And so the reverse mortgage is a combination of a HUD/FHA product, and in its guidelines, which go back to 1989, the creation of the HECM, this is what you will find: home equity conversion mortgage.
There you go. And thank God it's not a medical procedure. But and I did say at 62, you decided to retire the opening about a HECM. So tell us why I use that number 62. Why is that important?
Well, 62 is the magic number for the HECM. When it was created back in 1989, the guidelines of qualifying for a HECM state that a homeowner must be at least 62 years of age or older. So that is one of the qualifying factors when one is looking at a reverse mortgage or a HECM, is that you must be at least 62 years of age or older.
Yeah. So now that we know what a HECM is, and I don't care if we use reverse mortgage or HECM, I just want to unpack this for people so that they don't get tripped up in thinking that, one, FHA, and what do we normally associate FHA with? First-time home buyers. And why at 62 this kicks in. So let's unpack that real quick. Most people are familiar with first-time home buyers. They think of FHA. Why did HECM fall under the FHA?
Well, FHA is the one that allows for insurance on the product. And exactly why HUD chose FHA to deal with this type of product. Reverse mortgage, the reason there's a difference, and I want to point this out first, is that there are different types of reverse mortgages.
Right. Correct.
Right? We've got the one we're speaking of, which is the HECM, which is the one that is insured by FHA. And then we also have private reverse mortgages that are privately insured, not by FHA. So yes, reverse mortgage is the most common term that we would use to describe this product. Distinguishing the HECM from a proprietary is important because they do work a little bit different. There is different guidelines in qualifying, number one. There's different loan to value ratios as far as how much one can access from their home's equity. And there's different voids that each one can fulfill. So making sure that we are clear in what type of reverse mortgage is important, because this also goes back to pre-1989, and the biggest misconception of reverse mortgages today is that many people believe with the reverse mortgage, the bank takes title to the home.
Right.
And this was the case with different types of reverse mortgages prior to 1989. So therefore, when the federal government got involved and began insuring this product in 1989, that was one of the things that they made different about this product than those other reverse mortgages. So therefore, the term, why it was created to distinguish this type of reverse mortgage from other types of reverse mortgage. And that's still very important today because that misconception, unfortunately, still has lived on, even though there are not any products that reverse mortgage products that take title to the home, and certainly not the HECM product.
Right. And people, just so you know, I mean, in the mortgage space, I mean, there are other terms for mortgage. You have hard money loans, you have bridge loans, you have all these other avenues that you can get financing for your home. And with reverse mortgage, it's the same thing. But the one thing that I want to unpack, and I want people to understand, because this helps people understand why the HECM is different than the rest. And that is that word you keep saying, that it's insured. What's insured here, Rick? And why do you keep using that term?
Yeah, well, that's probably the most important aspect of this product. What is insured? Well, the insurance, the FHA insurance, provides a variety of different protections or assurances to the homeowner as well as the lender. But primarily for the homeowner, what that insurance does is that it protects one. Well, let me back up. First of all, it makes this product what's known as a non-recourse loan, which means that the only recourse that a lender has over the homeowner is the collateral, which is the house. And that is the only collateral in terms of what a lender can seek repayment from. So that's very important. Unlike most mortgage products in America, if you are unable for whatever reason to repay what you owe on the mortgage, the lender has recourse to potentially seize other assets that you may own. That is not the case with a reverse mortgage. This is the non-recourse feature of the HECM reverse mortgage. This is number one of the things that the insurance provides as far as protection for the homeowner. With that, it removes all personal liability from the homeowner. So you are not personally liable to this debt, unlike other mortgage products where you are personally liable to the debt, irregardless of what happens to your home's value. So this insurance, because it takes the risk from the homeowner, transfers it to the property, and it doesn't require you to make any payments above and beyond what the house is unable to cover. In other words, you have a HECM reverse mortgage, and over time, let's say that there's changes with real estate, and you end up owing more than what your home is worth. You're upside down. In other words, when you go to sell it or your estate, that insurance is going to cover any deficiency 100%.
Yeah.
So that is a extremely important aspect of the insurance and what it does for the homeowner.
Yeah. And that's why I wanted to unpack that, because I know when you get your head in this space and you're doing this on the regular, just like you start, not only are you aware of these uh, insurance issues and stuff like that, but I don't think we do a really great job. I know I don't, and I try my hardest to make sure that, one, I don't use acronyms, and then secondly, I'm defining the terms when I say this property is insured, or say for the for a HECM, the equity. So when we talk about equity, what are we talking about? So let's just unpack this. I want to make this really simple for people to understand. This is a home equity conversion. I guess I need another cup of coffee. This HECM is for the purpose of taking the equity you have in your home and reversing that, where now you are having someone pay you. So let's just simplify it just to make sure everybody's on the same page, because I know we're using this new word HECM and reverse mortgage. So we're taking equity and we're turning that into liquidity. So why is someone paying me for that, Rick?
Yeah. So the technical term home equity conversion mortgage, makes a lot of sense when you think about it. Home equity, which for most, we know that home equity would be right now the value of your home minus any mortgages or liens that you may owe against the home, and that would equal home equity, right? So home equity conversion, meaning that you're taking that home equity and you're converting it into a mortgage, which is this mortgage, which is liquidity, right? So that term right there helps to help people understand, what is the mechanics of what is this actually doing, the conversion part, right? And then the reverse mortgage term alludes to how we have been so accustomed with a traditional mortgage where we are required to make a payment every month. And by making that payment every month, what is happening in most cases is that a portion of our payment is going towards the principal of the loan, and paying down, in other words, the balance. So we make a payment every month, and every month that principal balance, what we owe, is coming down little by little, right? The word reverse helps to, again, paint the mechanics of this product, that because you're not required to make a payment, okay? And this is the biggest difference of the reverse mortgage versus any other mortgage, is that it's an optional payment mortgage. It's an optional payment mortgage. However, most homeowners who obtain a reverse mortgage elect not to make a payment any longer for a million different reasons. So therefore, by not making a payment, what is happening is that the balance that you owe, the principal balance, instead of coming down every month by making a payment, it's going up a little bit every month because you're not applying a payment. Hence the word reverse. It's working in reverse from how we have been taught since we were yay big to look at mortgages and real estate. So combining these two together, home equity, so I'm converting, okay, I get it, I'm converting home equity into this mortgage that then doesn't require me to make payments, so that I can have more liquidity, more access to this piggy bank that's called home equity that's sitting in my house at the moment. I can use it for a million reasons, and I'm not required to have to make a payment and be burdened with having to make a payment for, perhaps in many people's case, the rest of their life.
And Rick, if we use that money, we don't have to pay taxes on it.
Yes, correct. I mean, this is all, I love this product. I mean, I'm very passionate about this product. So I talk very highly about the product because I do believe that it can help so many different situations, so many different lives that it could impact.
Yeah.
So one of the many wonderful aspects of the product is that, yes, I can access this equity that I have through this vehicle, actually take cash out, use it for whatever purpose, and I am not required to pay income taxes. Why? Because it's not income. This is just money that you're borrowing from your property. It falls all under a mortgage loan, which for many people, hopefully this helps to dispel a lot of the confusion and mystery, because a lot of people think that this is something more than what it is, something mystical that was, created out of, some sort of, I don't know, some cauldron, but it's just a mortgage.
Yes.
It's just a mortgage. And the best way that I can simplify for someone is that it's an optional payment mortgage. In other words, if you want to treat it like a regular mortgage, you can make payments and pay down the principal every month, or you can elect not to make payments whenever you'd like. And in that case, then the balance is going to go up, hence reverse.
And what I like to say is, just because obviously I'm a simple little person here in Las Vegas trying to communicate this in simple terms. A forward mortgage, you pay the bank until it's paid off, and then the bank gives you the home. Reverse it, you own the home and the bank is paying you. And I wanted to unpack, and I'm so glad you did, this non-reoccurring, because so many people think, oh, you took a reverse mortgage. Now, once you die, the bank comes in and swoops and takes the house. Real quick, Rick, unpack that for us, because again, I'm trying to simplify this for people so they understand the terms and the terminology, but more importantly, like you say, the framework for this, so that it's non-reoccurring, meaning that what, Rick?
Yeah. So, first of all, the bank paying you back, that's a great way to look at it, is that I have now stumbled across this product in which the bank is going to allow me to tap into that, and they are going to, in a way, pay me back. Now, it's my own money that's there, but they're the portal, they're the vehicle, the reverse mortgage bank that is, and this product, to allow me to get into that housing wealth, which is mine, and liquidate it to me in a variety of different ways. A monthly payment was it's one of the three options. Was a little bit more popular, it seemed like, at the inception of this product, because it was an easy way to just kind of set it and forget it. Kind of. So it worked very well for a lot of people. And because of that, then it became known as, oh, that's that product where the bank pays you every month. Right. But that was simply just one of your three options, because you can also elect to take a lump sum payment at closing, or you can also set it up in a reverse mortgage line of credit and you make withdrawals whenever you'd like. Right. So that's again, why we've looked at it in that manner, in that light.
Yeah. I just love the idea that for people that are trying to look at their retirement and look at the funds available, that something like your equity could turn into liquidity, and it can fund your retirement at no taxes to you. Because like Rick said, this is your money. This is the equity in your home, and the bank's paying you for that equity. And at the end of the day, if you die and there is equity left in that house, Rick, what happens?
Just like any other mortgage, and that's another big misconception, is that a lot of people believe that, well, there's the catch. I was waiting. This is too good to be true. I can't tell you how many times I've heard that in my career. All right, this sounds good, Rick, but it's too good to be true. Where's the catch, right? And a lot of people believe that would be the catch, is that the reverse mortgage lender not only they're going to take title, but they're going to also share on the appreciation or take the equity
Right.
when that day comes. And that's not the case. So this works like any other mortgage. So when that day comes and you are no longer living there, okay, you've either passed away or you've permanently vacated, the process works the same way as with any other mortgage.
Thank you.
The estate's going to come in. They're gonna see the position of the equity of the house. They're going to make a decision, either retaining it for the estate or selling it. What we've seen in most cases that the beneficiaries end up selling it. So they put the house on the market. They get assistance from realtors, title companies, et cetera, to help them with the process. And during that process, they're going to get a payoff on what is owed on the reverse mortgage, just like they would with a forward mortgage.
Yep.
You get a payoff once the property is in process of selling. And once you get to the sale date, you complete the process. Whatever's owed, whether it be on a forward mortgage or a reverse mortgage, gets paid in full. And the remaining, this thing called equity that we're talking about, goes 100% to the beneficiary, whether it's a forward mortgage or a reverse mortgage. It works no different in the sales process, whether you have either of the two mortgages.
And that's what we're trying to do here at Inside Secrets 2, is dispel the myths and the misinformation about HECM and or reverse mortgage, if you want to use that terms, because at the end of the day, there are opportunities for you at 62 when you retire to take equity and turn it into liquidity. Rick did a great job on our first, and I'm going to link that here, on our first podcast with him, talking about using a HECM to buy a house also. So what I want people to understand is this: do not just take what you thought you knew about reverse mortgages, but take the time to talk to an expert and get the real information. Rick, what's the best way for people to reach out to you?
Well, you can simply Google me if you wanted to learn about me and see some of the things that I've done. So if you just Google Rick Rodriguez reverse mortgage, you're going to learn a lot about me and see a lot of the information that I have out there. You can visit my website, which is www.retirementhomeloan.com. You can also reach out to me directly at 702-460-6222. Welcome to text me or call me. So in any of those manners, we're Fairway Mortgage. We're licensed in all 50 states. Myself, my team, we are licensed right now in approximately 10 states, with more on the way. So chances are we can help either myself directly, many people across the country, or certainly, if it's not myself, I can pair you with another highly specialized reverse mortgage professional like myself, if it's in a state that I'm not currently licensed in.
And we're going to make sure we have all of Rick's links below this for you so that you can reach out to him. And here's what I want to encourage you to do. Take the time today. Invest in yourself, invest in the opportunities that are available to you by literally reaching out to Rick and asking him your specific question that wasn't answered here, or maybe something that got brought up that you'd want further information about, but do it today. And if you want a copy of this book today, you can go to keytovegashome.com under the homeowners tab. You can download a digital copy for free, or if you put your address in, I'll mail you a hard copy because I want you to get this information. Rick, thank you for being on the show, and thank you again for unpacking this. And more importantly, thank you for doing what you're doing in this space, because we need people like you to help unpack the misinformation, the untruths, so that people can move forward at retirement with greater security and less worry. And hopefully, if a HECM is right for them, reach out to you so they can start that process. Rick, thank you so much. We'll see you again next time on Inside Secrets 2.
Thank you, Ken. My pleasure.